In this lecture, I'd like to apply what we've learned regarding supply and demand analysis to market makers. Market makers are a type of financial intermediary that facilitate transactions that might otherwise not occur. The stock market is a classic example of a market that includes or utilizes market makers. If you own a common stock in Apple and you decide to sell that stock, most of the time you don't actually come face to face with the buyer of that stock, having gone out and found them, transacted, negotiated a price, etc. What you do is you work through a financial intermediary or a market maker. The market maker earns a profit by facilitating sales and facilitating the finding and matching of buyers and sellers. Essentially, they buy low from sellers and sell high or sell at a slightly higher price to buyers. If there were just a single market maker, we can ask how much that market maker would actually find optimal to offer sellers, and in exchange, or on the other side of the transaction, how much they would ask of the buyers, how much they would demand. I think it's useful to think about a stock market and a single stock. Let's take Apple as an example. Suppose there's a single market maker in that particular market, and all buyers and sellers, for whatever reason, are not able to efficiently come together and transact directly, so they utilize this market maker. The market maker has to choose or make a determination about how big the spread is between the price that they pay and the price that they receive in return. So for instance, if I want to sell Apple stock and you want to buy Apple stock, we'll go through the financial intermediary, the market maker. I will actually receive a slightly lower price for my stock than you will pay. You will pay the ask price, which is a little higher, and I will pay the bid price, which is a little lower. Now, in the modern era, that could be as low as 1 or 2 cents per share. But that bid-ask spread is the source of the market maker's profit. So let's look at this very simple example, supply and demand analysis. And the starting point here is a competitive equilibrium with no market maker. If you and I were able to find each other and transact in this particular market, the supply curve and the demand curve represent not only me, but all the sellers, not only you, but all the buyers. We can see that the equilibrium price is $8 and the equilibrium quantity is 5 units. Now, enter the market maker. The market maker needs to decide how much she'll charge you for the Apple shares and how much she'll pay me for my Apple shares. We can analyze the optimal bid-ask spread, or the most profitable bid-ask spread, from the perspective of the market maker, and this will help us to understand the economics of market maker behavior. It's also interesting to ask how many transactions will occur when the market maker sets prices to maximize their profitability. We can compute the optimal spread. This table is extracted from the graph that we just saw. It lists several different bid and ask prices, identifies the quantity of items or the quantity that would be transacted at those prices, and the profit to the market maker. The first row corresponds to that competitive equilibrium. If the market maker simply offered $8 and asked $8 for the shares, we can see that what would occur, or the outcome, would be equivalent to the competitive equilibrium. 5 units would be bought and sold, and the market maker would earn 0 profit because the bid and the ask prices are identical. Now, we can step down a row and ask what would happen if the market maker changed the bid and ask spreads just a little bit. Suppose that the market maker offered $7 to me and all the sellers, and in return, or on the other side of the transaction, was charging $9. Well, no longer would there be 5 sellers who are willing to sell at $7. From the graph on the previous slide, we could see that the supply curve at a price of 7 corresponds to 4 units. There are 4 sellers who are willing to sell at $7. A price of $9 corresponds on the demand side also to 4 buyers. So setting a bid price of 7 would attract 4 sellers, an ask price of 9 would attract 4 buyers, and in that case the market maker would earn $2 per transaction. With 4 transactions, the total profit would be $8. From the perspective of the market maker, we might ask, economically, what is the optimal spread from the market maker's perspective? Looking at these numbers, we can see that the optimal spread is going to be either $4 or $6. By spread, again, I mean the difference between the bid and the ask price. If the seller sets a bid price of $6, that will attract 3 sellers. If they set an ask price of $10, that will attract 3 buyers. The market maker always wants to set the bid-ask spread in such a way that the number of sellers and buyers are balanced and the market maker is not stuck holding an excess inventory. So a $4 bid-ask spread, $6 and $10 for the 2 prices respectively, would generate 3 units of sales, and at $4 profit per unit, a total profit of $12. The bid-ask spread of $6 with a bid price of $5 and an ask price of $11 has costs and benefits. On the one hand, the bid price of $5 attracts only 2 sellers and the ask price of $11 attracts only 2 buyers, so the number of units bought and sold goes down, but the per unit profit goes up, in this case to $6 per transaction. The profit again is $12. So from the market maker's perspective, the market maker would prefer, or if they were not encumbered from doing so, they would set a bid-ask spread somewhere in the $4 to $6 per unit range. Now we could also ask, what would happen if competition forced the spread down? Perhaps the market maker is faced with the entrant of a competitor, a second market maker, and that competition forces the spread down. If the spread were forced down from the $4 to $6 range that we saw just a moment ago to, say, $2, what would happen? Well, the $2 spread would correspond or could be achieved by setting a bid price of $7 and an ask price of $9. That would generate 4 sales, and with $2 profit per sale, a total profit of $8. Now, very simple example here, but one important economic insight is that competition among market makers forces the spreads down, and the lower spreads correspond to lower profits for the market makers. An interesting real-world application of this comes from looking at the spreads on the NASDAQ stock market in the United States between 1993 and 1994. Now, this was a long time ago, but back in 1993 and 1994, the spreads on stocks trading on the NASDAQ stock exchange were quoted in 1/8 dollar increments, 12.5 cents. So a stock might sell for $10, 10 and 1/8, 10 and 2/4, or 10 and 2/8, or 10 and 1/4, 10 and 3/8, and so on. Never would a stock in that era have been able to sell, say, for $10.07, because 7 cents is not an 1/8 increment of the dollar. So the spreads were quoted in prices were quoted in eighths, and the spreads then were also quoted in 1/8 dollar increments. On May 26, 2 financial researchers, Paul Schultz and Bill Christie, published a paper suggesting or identifying collusion among the NASDAQ market makers. It was a competitive market. There were multiple market makers. But if we focus in on what happened to the observed spreads, in 1993, those spreads were about 35 cents per share. On May 26, they were about 30 cents per share. And on May 27th, they dropped, cut nearly in half to about 15 cents per share. What Christie and Schultz had identified was that NASDAQ market makers were systematically avoiding odd-eighths spreads. There were fewer price spreads using 1/8, 3/8, 5/8, and so on than would be suggested by modern statistical theory or prediction. By ruling out any cost-based explanations for this overnight collapse in spreads, Christie and his co-authors concluded after the fact that by publicizing this conspiracy or collusion among NASDAQ market makers, they effectively undid that collusion, and it led to the collapse of that cartel. Now, we'll return to this theme later on when we examine various forces of competition and some of the things that firms do to try to minimize or mitigate that competition. But it's an interesting and direct application of this idea that left to their own devices, market makers will pursue or find it optimal to pursue large spreads because the larger spreads will be associated with higher profits. Competition drives down the spreads, and competition in this case drove down the profitability of making a market in the NASDAQ stock market. I want to thank you for listening to this lecture on market makers, the economics of supply and demand, and how market makers set their spreads.